CSL down 17% in a day.
Originally known as the Commonwealth Serum Laboratories.
Yep. Its number one product is snakebite antivenom.
Is it most sold?
No, it's not. But that's what it does. It does the snakebite antivenoms.
The companies that went from small and mid, like they grow all the way up to large cap. And I was like, does this actually happen anymore?
I would say it's similar to what it was 10 years ago. Maybe there's one exception that I think we're seeing more companies growing to that stage now because there's a lot of technology companies that are coming through now.
Yeah, did you get a bit of vitriol for your Sunday afternoon post about CBA and its falling dividend yield?
No, because we did talk about this last week.
I called this out as a bit of a chart crime.
Okay, go for it. I don't think it's a chart crime, but go on.
And everyone knows we often agree on everything. Like, sometimes we lack conflict here.
Come at me, bro.
Oh, I haven't checked the portfolios this week. Am I still charging away? I feel like this lead is unassailable though.
Do you reckon?
Yeah. 11 point. If I extended my lead, I think it's over 2% now.
Hold on a second. Let me bring this up. So
well over 2%.
Here are the portfolios.
You've only got one loser.
Yeah, consistent if nothing else.
But I guess
Dizzy Rascals, 5.98%. That's in the $10,000 portfolio for the community, which is a bit of a dog. This is the best one. Taps the chest. Beach the chest. 9.52%. Thank you very much. Thank you, Mon.
Nearly at 10. Should have bought an ETF.
Everything portfolio from Drew Meredith.
Did the IOZ or the IVV. One of us should have just done that for 100%.
Gee, bro, what do you think I'm doing over here?
Yep.
Yours is 11.56%. You're doing pretty well, Drew.
It's just Tesla.
What's your secret?
I keep getting emails. There's a client who reads a lot and has been sending a lot because he listens to this and he's also if I say the wrong thing on here,
he is listening.
He'll explain to me. Yeah, he's not a proponent. Like he understands how how economies work, modern monetary theory, and if we say something that kind of doesn't fully explain what happens, then he always kind of clarifies it with me.
Okay.
And he keeps sending me, like, one of Tesla's biggest shareholders has sold 80% of his, or one of his most important executives sold 80% of his holding in the last 12 months or something like that. So I'm not nervous whatsoever.
Interesting.
I should be close to the year. It feels like the kind of company that I could be sitting on a lead with like a day to go and somehow Elon Musk will come out at Christmas time.
He would be like,
destroy the stock price.
We're going to Mars.
Yeah, we're going.
It's official.
We're going to the metaverse.
The robots are here.
Let's change it.
The robots were folding my washing.
I watched For All Mankind and now I want to travel to Mars. I'm like, oh no. That sounds very capital intensive.
So good.
Let's hope not.
Yeah, so you're winning. For anyone that's just tuning in on the Australian Investors Podcast for the first time and you're thinking, what are these two idiots talking about? We're talking about our $10,000 portfolio challenge. Fake portfolio challenge. So at the beginning of the year, I got 10,000 fake Navexa dollars. Drew got 10,000 fake Navexa dollars. And the community got 10,000 fake Navexa dollars. Navexa tracks your portfolio for you, does all your tax reporting and that sort of stuff. It's brilliant. And as much as I'm trying to urge the team at Navexa to make my numbers go up, they haven't yet. So my portfolio second, Drew's is first. Communities has been weighed down by
Vulcan. And Kev Tui.
And Kevin Tui, who suggested KKR, which was on a tear for a bit. But Mader Group, which does the mining, engineering services, labour hire, all that sort of stuff, is absolutely crushing it up 35%. So, really good.
I'd like to point out pretty much every holding apart from Yarra is up 10% for me. And Tesla, which is down 20.
Yeah, you're doing pretty well. Yarra was struggling last week. I'm pretty sure it's negative.
Anyway. Low single. I think it was low singles.
Right, okay.
Car sales had a good report, didn't they?
On my numbers, Exeter Scientific came out with a pretty good result this week. Profit was up pretty considerably. Good business. People thinking it's cyclical. It's not. It's good to see the share price back up. Let me just bring this up in the ticker terminal, which I should have here somewhere. Here we go. Yeah, Ticker. So Ticker is official sponsor of the Australian Investors Podcast now, Drew, which is great. With the Ticker terminal, you can search for any company basically you want in the world, analyst transcripts, run valuations, all that sort of stuff. But
you got any referral code or anything?
It's RASK.
RASK? Oh, all right.
Yeah, RASK. You just go to ticker.com/RASK. Thanks for the nudge there. So
no, I was trying to do it myself.
Oh, right. Okay. Yeah.
And PocketSmith, is PocketSmith a partner?
Yes, that's
This isn't a setup either, just be clear. I was actually looking at this for myself.
RASK.
Yeah.
PocketSmith's like a rocket ship, though, to be honest. When you step in there, you have to set it up correctly. And once you do, it's awesome. Maybe you use Xero for your businesses?
We do for the business, yeah.
Yeah. So PocketSmith's like Xero for people that are in like finance.
Yeah.
Because it's like once you set it up and you've got it's all automated and it checks. It is remarkable.
It's like not machine. You tell it once, and
then
it
just
allocates
remembers.
it appropriately.
Yeah, and then it will be like, oh, you spent money at BP, so that should go in this category, and this and that and this and that.
It could be some snacks in there too, but I don't think
Snacks,
put a lot of fuel.
There's a lot of fuel in there.
I'll start gaming.
Thought you had an electric car. Yeah.
Some salt and vinegar chips.
But as we can see here on the screen in front of us in the ticket terminal, XRF Scientific's numbers, revenue was a bit modest, but profit was up considerably. Wonderful business, small cap business. XRF is the ticker symbol. It does, that's going to get people, it does X-ray fluoroscopy, testing and lab materials and crucibles. So what does all that mean? It basically tests stuff in a lab and it sells the machines and the bits that go with the machines to do the testing for like mining companies and that sort of sampling. But it's a really good business, still relatively unknown. I know the Dome owns it. We did get a comment on the YouTube channel about the Dome this week. What was the comment?
There are a couple there. Noting that Luke shares an office with us.
Yes, Luke Larrative.
Yeah. And lovely guy. Good friends. I think there are a few comments on there that were like, geez, this guy must be good if he talks this. I mean, if he's this arrogant is what they actually said, but I was trying to be nice.
He must be good if he's this arrogant.
And it's like, oh, geez, this guy's head is everywhere at the moment. Probably referring to the fact that he does a few Livewire.
He does Livewire, does RAS, does Echo.
You ask him to do it. You put a camera in front of him. Yeah, he's ready to go.
Like, yeah, what are we talking about? It's the Dome actually came on this week, gave us an update, and we do have a few comments here from. Actually, I'll bring this up on my laptop so I can see. No, this is just feedback because the Dome's coming back in a couple of weeks with Ben. And they are going to do a reporting season roundup for us. So
nice.
Buy Curious wrote in and said, suggesting a company for the Seneca team to review, Australian Ethical, AEF, noting that it's up about 100% in the past 12 months. About 12 months ago, I thought that Australian Ethical shares were already so expensive.
Yeah.
I remember
one of a difficult period. They halved.
One of the riders has it halved, does it?
No, they were down 70% at one point.
Because at one point, we did some numbers on this, and one of our contractors did some work on this for us. And he was like, yeah, if it stays at the current valuation, you should get your money back in 2039. And we're like, maybe
I feel like
don't talk about
would be
it.
pretty good though.
Look at that revenue.
Like ESG
just
generally
up and to the right
has kind of, not just because of Trump, but there was a trend that everyone was trying to do ESG, so environmental, social governance investing, and ethical is a lot different to that. But it kind of I think that's also where that peak came in 2021. I bought well before the peak. I'm a shareholder.
Thank you.
And it's recovered. It's had a great 12 months or so.
But the big play with Australian Ethical is the superannuation business.
Super fund.
Yeah. They have that really expensive managed fund as well. It's like 2% still.
Like a balanced fund. Yeah.
No, there's like a small company. I don't know what it is, but yeah, I mean,
you always need to pay a bit more for ethical and for ESG because you'd expect them to not rely on a computer or AI to just take care of those kind of assessments.
Yeah.
But it's definitely at the more expensive end.
Yeah. So for people that are listening, like say
they run a retail
10 years ago, it was 33 cents a share. Then it went up to COVID at like $14. Then it went straight back down to $3 in 2023. And it's been up now, it's back up to $8. I think it's a wonderful business. I think it's just a great business. It's kind of a beacon for ethical investing in our country or responsible investing. I don't own it. I've been tempted to many times, but it's a really interesting business. So we can get
funds management is like one of the best business models when it's working.
Yeah,
so
on
if
the way
you've
up.
got good performance and you're getting assets come in. I think they've done some acquisitions as well. Then the scale is massive because you don't have to add a new person for every $100 million that you get.
Yeah, no. Then the other company is Smart Parking. SPZ is a ticker symbol.
Like the actual parking lots, or
yeah, I believe so. I'm not as familiar with this business. I think we had someone come on not too long ago talk about it. Again, another business that has been on a tear recently. Last say 12 months, it's more than doubled. Master Parker wrote in, said, would love to hear the thoughts from Owen, Ben, Luke, etc. on SPZ, longer-term shareholder in it and a big fan of the concept, but sometimes it doesn't seem to be on anyone else's radar. I feel like I saw this on Strawman, Master Parker. Maybe it was Claude that was talking about it too.
Really, like these are tough sectors to invest into to get enough knowledge around. And
but I think this business,
that kind of
we'll do some more work on this before we pass a lot of judgment, but I think this business is actually really innovative in the way it does it. So I don't want to comment too much because I can't remember when I actually looked at it maybe 3 or 4 years ago. So it offers Smart Cloud, a cloud-based car park management platform that gathers and processes information, a compliance management system, does camera systems. It does like a lot of technology around car parks. So it's
don't just lease the car park and extort.
No, don't.
People that want to park.
Yeah. No, I remember this from many years ago, and I remember seeing this. That's right. I remember seeing the CEO at the time talk. I do a prezzo. So,
like where you go to Doncaster Shopping Centre and you don't actually have to scan anything; it just scans your number plate.
Yeah, Well, we should. We'll find out more about that. Maybe the Dome and Ben have something to say about that. You do have some general questions for the top of the show, though, Drew.
I think this is like a perfect lead into a thought I was having this weekend. You can call it a brain fart or something as well. Which is
this when you were high-fiving the Western Bulldogs mascot?
That was a massive highlight of the week. If we can touch on that if you want quickly. It was
so Drew is a absolute huge Western Bulldogs fan in the AFL. So. Yes. He's got a poster of Marcus Bontempelli above his bed.
Let's not go there. In fact, Bontempelli not my favourite player, but that's fine.
Oh, really? Who is your favourite player?
I mean, everyone loves the Bont.
He is great.
I think I'd lean more towards Ed Richards or
fair enough.
Rory Lobb or Tom Liberatore.
Yeah, classic.
Yeah.
You're a sucker for a man in tattoos, aren't you? Go on.
We were lucky enough to be invited from a friend to go over the Guard of Honour. So when the players run out next to the banner on the way out, and my son actually, Ed Richards actually sent him a personalised birthday message. Yes. I think I might have shared that with you as well. Yeah. So he waved at him on the back of the thing, and then the LA Rams, so going to the US sports, the LA Rams mascot came out and photobombed us, which was fun. But it was, I think like the highlight of a 7-year-old and a 4-year-old's week. Got a high five from Rory Lobb.
That's so good.
And won't stop talking about it.
Good on him. Good dad moves. So what questions do you have?
Good segue. So I was thinking when we were talking about all these small stocks that are going up 100%, I was interested, like I remember looking at, there were a lot of mid-cap, large-cap funds that were talking about the companies that went from small and mid, like they grow all the way up to large cap. And I was like, does this actually happen anymore? Mm-hmm. And that was my question to you. Do you think it's become more common or less or more common, or you think we're seeing less companies go from maybe $1 billion in Australia, $500 billion into the top 20, into the top 50? And do you think there's a reason for it?
Well, there's only ever going to be the top 20 or top 50. There's only a limited number of companies in that
It's hard to get in.
But I would say, just generally speaking, I would say it's similar to what it was 10 years ago. Maybe there's one exception that I think we're seeing more companies growing to that stage now because there's a lot of technology companies that are coming through now. There was a time, probably like up until about 10 years ago, that anything that was decent in the mid-cap Australia, as soon as the Australian to US dollar exchange rate fluctuated, the US companies would just buy them out.
Yeah.
And that happened with Altium. Some people might remember Altium that does like printed circuit board design. It's like a big Internet of Things software subscription play. I held the shares for many years. They got bought out a couple of years ago by Autodesk. I think it was Autodesk in the end. And then Siemens bought Mentor Graphics. That was another thing that happened earlier. But so I would say that to answer your question, we are seeing more of that happening. WiseTech, Xero, Pro Medicus, less so RPM Global, NetWealth, Hub24,
but a lot of them were a while ago.
Even like Clockley's been around for a long time.
More than 5 years ago, a lot of them.
Yeah.
When they first came up.
Yeah. But then, Life360 is a new one that's really doing it. Objective Corp. ARB was probably a bit further back. A lot of good companies coming through. JB Hi-Fi we talked about last week.
Yeah.
So why did you? So why?
It just feels like it's not happening as much. So if you look at the ASX 100, fair enough. The 20, you're never going to break into the 20.
Yeah, those
companies are too big.
Yeah,
Banks, Resources, Global, but it seems very hard to get into the 100.
Saying that, WiseTech
is near the 20.
WiseTech's near the 20. I'm going to get the ASX 20 list. I don't know who has got that.
And it didn't make for great reading. I mean, I didn't read. I asked Claude. Anthropic's Claude to help me. What were the inclusions and removals from the ASX 100 over the last, around about 5 years, and it was like Pro Medicus would be one of the highlights. Life 360, Hub 24, and Pinnacle would be like the like these really fast growing, and then you basically got Paladin went in, then came back out. So the uranium company, Lithium went in, came back out.
They're like Vulcan,
like Viva Energy, in. Pretty sure it came back out too.
You couldn't trust those as far as you could throw them though.
And then it wasn't much better in the US. I think from memory, I was looking at over 5 years or so, and there's not a lot of change in the US. It feels like, but it was like the only things that went into the SP 100. Let alone anything. So from the 400 into the 100 was Palantir, Intuitive Surgical, ServiceNow.
Yeah, boy.
And John Deere and Co.
Yeah, John Deere's a wonderful business.
Have you ever looked at that?
It's actually we should do it. I'll do a deep dive on John Deere. It's actually a wonderful business. Yeah. So those other companies, Palantir.
And Dow, Kraft, Ford and Walgreens came out.
Intuitive Surgical.
Like there's a bit of a trend there. Yeah. Like, is this because more and more companies are going private, like you said, or are they being gobbled up? And there's some articles about large tech companies basically buying any mid cap that looks like it's got something they don't, so they just go out and buy.
But I feel like that's always been the case, right? Yeah. Like you go back to like
conglomerates.
What was it like? Philip Morris was buying like bloody cereal companies and all this sort of shit. Like, you know,
and General Electric owned
Philip Morris has been the cigarette company for people that don't know. But like,
don't go out and buy it.
But okay, so we've got here on marketindex.com.au, in the top 20, WiseTech slips in there at number 16. So WiseTech's there. That's a story. That's a good story. That's a good story. REA Group.
That's been around for like
Pro Medicus, number 19, and then Sigma, which is Chemist Warehouse. So I think that of those, I don't know where REA grows from here, but WiseTech, Pro Medicus, Sigma. Pro Medicus is very expensive, as we talked about, but they could be
a couple of homegrown, like 2 homegrown.
They could be bigger companies than some of these on the list. This Woolworths Group, I feel like that market cap's not correct. It says Woolworths is only worth $40 billion market cap. That's
right.
You could blink and it would be smaller than WiseTech.
Yeah.
Rio's obviously got its dual listing, so don't let that for you. Transurban's 43 million. That's a toll road. That's never changing. Aristocrat owns the gaming and that sort of stuff. It's 44 billion market cap. WiseTech, Woodside's 50 billion. And then you start getting into the big boring stuff like Telstra and that.
Not all boring. Number 5 there.
CSL down 17% in a day.
It was a shocker.
Absolutely.
That was my question. What happens when the biggest stalwart in your portfolio goes the wrong way? And CSL, for context, has been bought by almost every retiree I've ever met.
Yeah.
For $2, anywhere under $10 a share. A lot of people bought it at $2 a share.
Yeah.
Originally known as the Commonwealth Serum Laboratories.
Yep. Its number one product is snake bite antivenom.
Is it most sold?
No, it's not. But that's what it does. It does the snake bite antivenoms. For people that are,
I'm pretty sure that's not the case, but I'm not going to.
No, CSL Behring, blood plasma, bro. Plasma. It collects blood plasma and then refines it and turns it into medical products. But the big difference, people don't understand this, is when you give blood in Australia, it's free. You might get a cookie. Go down and give blood, by the way, people. Australia needs blood right now at Lifeblood. It's free. We don't get
paid in Australia.
We don't get paid. In the US, you get paid to give blood. Yeah. So when CSL talks about collections and donations, or not donations, collections, it's actually paying for that blood, which it then turns into blood plasma and these types of things. But seriously, if you get down to your local Lifeblood, give some blood. It's a really good thing to do. And support, if you're an employer, you can also support your team to give blood as well. You can set time aside. You can give them special privileges for doing so or recognition. Really good thing to do because Australia needs it.
The drop wiped more than 50 points off the ASX 200.
Which is crazy. That's what I was thinking about. Like we don't own CSL. It's in one of our ETFs, the VAS ETF.
And it's what, the fifth biggest holding. Probably most people that invest in Australia.
Ginormous. Yeah. But so people were asking about this on the RAS community. So revenue was up 5%.
The result was pretty solid.
Yeah, but the problem is when you've got, revenue is up 5%. And just as an FYI to anyone that doesn't know how to read financial stuff, companies always come out with like an ASX announcement.
Because there's 3.
It says full year NPATA, which figure out what that means. US 3.303 billion. 1, 2, 3, 4.
1, 2, 3.
1, 2, 3 as an asterisk, up 14%. That is a huge
net profit.
It's not a chart crime because it's not a chart, but it's basically that's a joke.
Net amortization because
Yeah.
amortizing all the
They'll be
R&D that they
amortizing
do?
something.
All the R&D.
But then,
Because you don't want to expense R&D as soon as you spend it.
my brain's just turned inside out. But I would say when you read an ASX announcement, it's just for everyone's. When you click on the one that looks good, that's not the legit one.
Yeah.
The legit one is the one that actually has like 100 pages, and you're not going to click on it. That's what we call an Appendix 4E. That's the official one where they have to give the actual number. So if we see here revenue from ordinary activities up 5% to 15.5 billion.
Revenue net profit after was that?
Are they still doing that? Okay, so I'm trying to make heads or tails of this. So reported NPATA attributable to the parent company, I'll accept that for this, was $3.2 billion, up 11%.
Vifor is a separate business unit.
They might have equity accounting use in the P&L, but for people that don't live in that world, don't worry about that.
If they own a majority of a company, but it isn't part of their
It isn't part of their P&L, but they have to recognize it anyway. So if we continue with this story, so why would a company that's growing revenue at 5% and profits up, quote unquote, profits up 11%, why would that fall 17%? And I think, honestly, Drew, it just comes back to valuation. It's just, I think they're cutting some jobs, they're changing their business model, but share price is absolutely trucking along. I've been very negative on CSL for at least 5 years. At least.
Yeah. And it's gone from 100 to...
Yeah, it's gone. What's it done? For 5 years? Have a look at that, actually. Look how... Oh, no. It's a bit of a shark tooth. It's not that bad.
It's a head and shoulders.
It's a head and shoulders routine. No, so when I say shark tooth, what I mean by that, for people that are listening, you can visualize it. It's kind of like
up, down,
jagged up, down, up, down, up, down. And you see it in a lot of like...
which usually means you're getting good earnings growth, and then you've got to downgrade, then your earnings growth.
Yeah.
Then you've got to downgrade, then you've got to earnings growth.
Yeah.
Usually, like insurance companies, I see go upgrade, 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 big downgrade, upgrade, upgrade, upgrade.
Yeah, exactly. And then you
More
get
like
like
a
cash management trusts do this as well in their reporting. One of the things that when I say I've been negative on it, I actually think that it's a wonderful business. I think you'd agree. But this is the problem that I've seen with it for at least 5 years. If we go to financials here.
Profit growth's slowing.
Yes, but there's something else I want to show you. So if we go long-term debt, I've shared, this is the chart that you need to look at. So long-term debt for CSL, starting in about 2012, 13-ish, started to ramp. Why? Because the business got to a mature phase, it was doing some acquisitions, and interest rates were plummeting.
Yeah.
So every time there was more interest rates being dropped, they would just
2% loan.
Just 2% loan. They would just get more and more debt. And then they would then maintain their dividend policy, which the franked shareholders love.
Yeah.
Maintain their dividend policy, but feed on debt.
Not that they pay out much, yeah.
No, they don't pay out much, but it was a good excuse because then if you're also incentivized for a return on equity, what's not captured in return on equity?
Debt. Yeah.
So I saw this and I was like,
They had a big acquisition.
Yeah, they did some so we don't look at the last 2 years, but there's this gradual incline and they started to pay back some of their debt and all that sort of stuff. But that is probably the thing for me is it's just getting towards a mature business. If it can grow at 10% per year, great.
Which apparently it can't.
But
expecting 7 to 10% profit growth. And I think people are used to low teens at least in profit growth from CSL. And that's like if you think go from 14 to potentially 7, a halving of the speed of growth in profit.
Yeah.
And that's there for profit. It only provides a dividend for like 1%. So you have to be there for profit.
You do.
Or for earnings growth.
But that's why you've seen in the last 3 years, the price to earnings ratio has retreated from 40 to, what is it today?
Derated.
It's 23 times according to the ticker terminal.
So they're trying to, they've had a couple of their big, I think it was CSL 112 for lack of, didn't fail, but they had to basically stop the tests that were happening with it. And that was something that would help in 2031.
Yeah.
And that's why the outlook becomes more difficult. And that's a 6-year ahead outlook. And that's what matters most for these companies.
Yeah.
They did say they're going to spin out Seqirus, which is the vaccines business.
They bought that in like 2015, 2016.
Yeah,
off the top of my head.
Like solid business, like revenue up 14% of revenue at $2.2 billion, and it will be worth $17 billion when it lists on the ASX, which they expect to happen next year. So it becomes like one of the top 50 companies on its own list.
There you go, mate. Don't even need to make them grow. Just put them.
Yes, just break them up.
Just break up one and put another one in there. So that's revenue is up 2% for the financial year. So they're going to need to do the investment bankers are going to need to do some engineering.
Yeah.
They're going to have to do, this is what I would do if I was an investment banker consulting to CSL. I'd be like, all right, guys, we're going to sell, how do you pronounce this thing? Seqirus. We're going to sell Seqirus, and what we're going to do, you know all that debt that the guys on the podcast just said we've got? We're going to put all that in that company over there. And then we'll sell that to the...
Sounds like South 32 all over again.
Yeah, exactly. We'll sell that to the punters, and then we'll keep the good one over here. And everyone will be happy. And that's what they'll do.
Yeah. And they're not keeping any ownership in the company.
No, they'll flog that one. Well, they'll say we're keeping some stock.
I reckon they actually set the podcast and said.
Yeah, that's what they're going to be. This is happening in CSL headquarters right now. But then what they'll do is they'll say, there's limited stock. We're going to keep our stock, and the index funds will start, yummy, new CSL entity, keep buying it.
Yeah.
And then the bid will go really high, and then they'll dump all their stock. What's that? Wesfarmers and Coles. Back to the Land of Living.
I was always got a question about that. So many people come with a massive holding in this.
Oh yeah. So the actual question
we always say is like position size. Like position sizing. If there's clients that have got $1 million in this. They've lost $170,000. If that calculation's right, in one day. Like that's not something that's and people go, they got $1 million in it anyway. But some people, and this is probably a financial advice question that comes up all the time, is what is it worth paying the tax when you've got such a big holding to reduce the impact of things like this happening? It feels like it can never happen with CBA or CSL, but we know that it can. And that's when we see people, I'm sure the same, you go as hard as you can on the first recommendation. Cut this as much as you can, and then find out how comfortable they are with it, because they're hard things to get people to get out of. But it can be not that it's like if you've got that much, it probably won't impact your lifestyle to much of an extent. But the psychological hit of losing $170,000 in a day doesn't disappear.
Yeah, it's tricky. It's hard because obviously we make decisions in a vacuum.
You'd have Pro Medicus, you'd have all these companies that's got massive gains on them.
You've got huge taxable gains that people have to pay at a time when if they're not retired yet, they've got large taxable incomes. And if they are retired, then they can maybe afford to do it because they'll have pension streams from super that are tax-free. But I don't know. We see a lot of people inherit a lot of CSL and BHP and all that, and they're happy. They're whatever, testamentary trust, they're less likely to hang on to it. But I would say that I would be nervous if CSL or CBA were 10% of my portfolio. Like I'd be very nervous, especially with CSL, not so much with CBA. But the crazy thing is if you only owned one ETF, like if you only owned VAS or you only owned an Australian index fund, guess what? 10% of your portfolio is CSL or CBA.
No matter what, everyone's impacted by it.
We own VAS, but VAS is only one of our ETF holdings. So I would be nervous at that. You'd have to, it's a circumstances basis. So we've got probably time for a few questions, but I think you wanted to ask a couple more questions.
Yeah, did you get a bit of vitriol for your Sunday afternoon post about CBA and its falling dividend yield?
No, because we did talk about this last week. So let me bring this up.
I called this out as a bit of a chart crime.
Okay, go for it. I don't think it's a chart crime. But go on.
And everyone knows we often agree on everything. Sometimes we lack conflict here.
Come at me, bro.
So
what do you got?
You've got a caveat over this. You're talking about and I'm not saying I don't agree with you. But you were saying that...
So you do agree with me. You just used a double negative on me. And my brain just fell apart. What are you Okay, go on.
I'm being a little bit facetious here.
Okay, go.
But here we go. So you made a big song and dance about Wesfarmers and CBA essentially having dividends in structural decline.
The dividend yields are in structural decline. So you're saying that that's a misdirection?
I reckon that could be bordering on chart crime, I think. So, because technically... If you look at the dividends in the last 10 years, yes, it's slowed. I mean, the pandemic is a pretty big hit for everyone, but they have actually, the net dividend, what matters to people that bought 2016 to all those different years has actually still been increasing, albeit to a lesser extent than it was before. But true is that the dividend yield has been dropping for one reason.
So
because the share prices have gone up,
the
and
valuations
have gone up so
it's
significantly.
two-pronged.
Yeah, it's like equity yield premium.
Yes, in a roundabout way. So yes, so if you peel back, let's say we go to away from stock market investing 101, which is what the PE ratio, to then you go beyond that and you go to, well, what is this thing called equity risk premium? That's probably level 201. That's up in the second floor of Monash University. So, so in this room, what we would talk about is we would say the equity risk premium is the long-term return that you get from taking risk in equities, so shares. So what we mean by that is if you put your money into, say, just an index fund in the ASX, on ASX, versus putting your money in a term deposit, this is the easiest way to conceptualize this. Over time, what is the expected return difference that justifies making that trade, right? So historically, we can measure this and we can say it's about 5 to 6%. Because say 10 years ago or 15 years ago, cash rates were 5%, like the interest rate was 5% and the stock market return was 10 or 11%, right, historically. So at that point in time, you'd be like, oh, well, okay, so I get an extra 5% for taking the stock market risk, right? So then you think, okay, well, what would that be now if I was to do the numbers now? Well, we know that the banks are offering, like ING, I saw the other day, was offering still 5% on the savings maximizer. Yes, it's got a bunch of hurdles that makes people jump through and it's not as good as it used to be. But 5%. And the yield on a stock, which has equity risk, is like 3%.
The ASX is now 3.2 or something like that.
Yeah. So in effect, it's inverted.
Yeah.
And what that is telling you is that people need more growth to make up more of that equity risk premium. But if these companies aren't growing that fast, what does that say to you? So historically, I did some numbers for the community the other day.
It's like when it was at 6, it made more sense to be buying it for dividend.
Exactly. Whereas now you have to buy it only for growth because it's factually, the numbers say that the only reason you're doing this is because you expect earnings to keep growing. As we just saw with CSL, 1 year of earnings was pretty good, but that's declining, right? Probably should have used CSL and CBA rather than Wesfarmers, who sells beautiful Bunnings sizzlers out the front. So my point is that if you go back 20 years ago, Drew, say you got a 10% return from the stock market, approximately half, maybe even sometimes a little bit more, was from the dividend, and half was from growth.
Yeah.
So if we wanted a 10% return back then, we would assume that at least half comes from dividends.
So if you get a 5% yield, then you're halfway there.
You're halfway there.
Yeah.
But then now what we're seeing is that effectively the yield's fallen to 3%. If someone still wanted a 10% return, they would have to assume that the earnings are growing at 7% and the valuation holds. Because if the valuation doesn't hold, you're stuffed.
Yeah.
Which we found out with CSL. So
yeah, we all price in 10% returns every year.
But the reality is, here's a bit of pop trivia for you. I agree with what you're saying. It wasn't a misdirection. It was just a derivative of the actual problem. So I want to ask you a question.
It was a good way to frame it, I think.
Yeah. What has the FTSE 100 returned over the past 25 years? This is the UK stock market.
Per annum.
Per annum. Give me a figure.
FTSE
Total
100.
return.
6%.
So if I drop in here, this is on curvo.eu. Over 25 years, compound annual growth rate of 3.55%. But if you go total return, last 20 years, 5.2%. That's 20 years, not 25. So
you're better off holding bonds.
You just...
The FTSE.
I don't know what you do in England.
Have another pint.
Yeah, just go down the pub. But my point is, I don't think we're in some sort of productivity deficit like the UK is, but I do actually think that it's at this point of the cycle, like people need to be realistic.
Yeah.
And
be wary, particularly during reporting season.
If you tell all these people on Instagram about, you know that your index fund might return 4 or 5% for the next 30 years, they'd be like,
no, it's 10. I've already priced it. I'm already a millionaire.
I've got the Vanguard Interactive chart over here, mate. What are you talking about?
10% compound of 25 years.
So my point is, I think that we'll still grow at 5 to 10% as a guess, but it could be less.
Yeah.
I don't know. So just maybe diversify.
It's like when you compare, what was it, the purchase of like the LA Clippers or something? It was like,
yeah, just put it in.
Should have put it in IVV.
Yeah, Donald Trump should have just. There's a way. I love this post from Morgan Housel quite a few years ago. He did a bit of a back test on Donald Trump's net worth. If he just took the money that he got and then put it in an index fund, he'd be better off.
But it wouldn't have been fun.
No. Okay, we've got time for a couple of quick questions here on the end of the show. If you do send in your questions, we absolutely love them. Don't forget, we've got the Dome and Ben coming back in the next couple of weeks to answer some questions, to go through all of reporting season, the winners, the losers, the absolute, pigs of the ASX. We're going to cover it all right here on the Australian Investors Podcast. But we do love to hear from you here on the Saturday 2 Cents Show with Drew and I. And the best way to do that is to follow the link in your podcast player or in the YouTube description. Just hit that link that says Ask a Question and select the Australian Investors Podcast. If you do write into us and you want to claim a prize, we'll give you 60 days free to Rask Core, which is a membership that we offer here at Rask. So the first, just a quick disclaimer, any of the questions that we do answer are strictly general in nature. We don't know your needs, goals, or objectives. That's why we ask for a funny name as well. So speak to a financial planner before you act on the information. If we talk about ETFs, super funds, etc., they've got a PDS. So check all that out and learn more about what we can and can't say on the Rask Group.
Not too funny.
Not too funny. On the Rask Group's financial services guide, it's rask.com.au/FSG. Leverage. I think, we've already answered that question for this week. Delivery boy. This is a bit of a tongue twister for you, Drew. I wanted to see how you respond to this one. Delivery boy. I have 2 pepperoni pizzas.
I love pepperoni. Like if there was my 2 favorite foods, pepperoni pizza, roast chicken roll.
Jeez, you're making me hungry. I have 2 pepperoni pizzas. One was bought in COVID at $70, which is now $100. After COVID, I bought another pepperoni pizza for $30, which is now $33. Should I sell my first pizza and buy more of the second pizza, given they both track the same pepperoni pizza index? What the heck?
Is this comparing like 2 ETFs that are priced at different amounts? I feel like it is.
I feel like we could. Let's try and untangle what this person. I'm going to guess that one of them's VAS.
And I think there's a thing here.
$110.
$110.
And then would it be A200?
Yeah.
148. IOZ? 35.
Yeah.
That's it. So they own, we're guessing, VAS and IOZ, which are one's an ASX 200. That's
one's ASX 300.
One's ASX 300. And you said a comment last week, which I didn't pick up on. You prefer the ASX 200 to 300. Why is that?
Because I think anywhere that you go outside the ASX 200, and I know there's not a huge exposure in the ASX 300. Anything outside the 200, I want active management because we know that that's where you can go to the Spiva data. Small cap, mid cap managers tend to outperform more consistently than large cap. Okay, that's why I you have to pick something. It's like, but then why is it 3? And obviously as an advisor, you constantly get asked the question, but why? But like from children. But why?
Yeah.
And that's the reason why.
Okay. So
I think the thing here is that basically we're talking about ETFs that have different dollar values, but it doesn't actually change the dollar value of or the allocation that you have to the underlying shares.
So the overall pie is still saying Australian shares.
Yeah. You don't get twice as much allocation to the ASX by buying one over the other for each unit that you're buying.
Yeah. Yeah. That makes sense. Okay, so...
Does that make sense?
Yeah, it does make sense.
So each time you buy a unit in these, you're getting an exposure to each of the, or not necessarily, let's not get into that detail. You're getting exposure to each of the 204 companies that are in the ASX 200. And yes, there can be more than 200 companies in the ASX 200. And you're also getting an exposure to each of the companies in the ASX 300. I think the key here was that there was a big thing with IVV a year or so ago where the share price had gotten so big, it was like $350, that people who were reinvesting
I think it was 600
dividends.
Yeah.
And it was very hard to buy one new unit in IVV. And if you're reinvesting a dividend, your dividend was $8, well, you had to wait till you had $350 to get a new unit. Yeah. So that's why they consolidated and put their share price down. I think it was one in 10 or something from memory. So you're still buying the same exposure. It's just these things start at different prices. They've got different structures, and they're both going to show the same performance, very similar performance.
Yeah. I agree with everything you said. Same performance, it's the overall pie that matters. Yeah. The only thing would be like the tax position if you wanted to simplify your life and admin and that sort of stuff.
One or the other, but then you're probably realising gains to do it.
Yeah. Here's an interesting question that's just come through. With bank interest, this is from Cashed Up. This is a good question, actually. I can bring this up for you here, Drew, so you can see it. With bank interest low and potentially becoming lower, could it work to put most of your savings that would have gone into an interest account into a higher dividend paying fixed interest bond or something like that, knowing that as you need funds, a broker fee will need to be paid? I actually get this question a lot at the moment is,
should you buy bonds?
Yeah, not just bonds. Is like, we're seeing this is people are tipping away as interest rates are coming down. Properties obviously started to go up, but the demand for property. But the other thing that's happening is I see people once again, like they did pre-COVID, pushing more money into securities like
slot or
IYLD or say for example, we use the MMKT ETF, which is like a kind
Money
of like
market,
that ETF is like a bit of cash and a bit of enhanced cash.
bank bills.
Yeah. Instead of just going cash, they just go enhanced cash. And then if they're enhanced cash, they'll go to a very mild version of credit or something. And then if they're there, then they'll go to something else. And are you seeing that with your...
I think we get the question quite a bit. I think it's easier to hold cash than it has been for a while. Like you're actually getting 3 or 4%, but now people are like, oh, 3 is not enough. I should be able to get 4. I'm seeing it quite a bit, but you have to be very careful. Like if you're going into a fixed rate bond of any kind, whether that's government, whether it's like a subordinated bond, and it's fixed rate, you're introducing duration and volatility and capital risk. Because if interest rates go up, your bond's going to be worth less. And if you need that for something, obviously, if interest rates go down, you get the benefit of it. Seeing it more and more, and I probably find that more relevant for these kind of circumstances is that I know people don't love taking on floating rate, like floating or variable rate risk. Yeah. But you can buy a floating rate, subordinated bonds, senior bonds that are yielding similar or if not slightly more than cash, issued by the banks. You can talk about default risk.
You mean like a sub D, like a VNX?
I tend to be more go floating in these circumstances.
FOLT from someone?
We used to have much easier access to money market funds in Australia. I sound old now.
Back in my day.
Like in the US, money market funds are huge because you have to get your money off your broking platform because they're taking money off, taking a clip on the cash account. So people use money market funds and they usually offer like 1% or 2% above the cash rate. Without those in Australia, which are very rare now, I think it's natural to go towards these, and I just tend to gravitate towards floating versus fixed rate.
Yeah, you said last week that you're about 50-50.
IYLD.
Yeah, FLOT from VanEck.
IHCB, I think it was one of them. You just got to be careful and you have to be comfortable, not careful. Everything that is fixed interest in Australia is going to be either government or banks.
Or government or banks, yeah. So it's got a running yield of 4.55%.
It's not bad.
Yeah, it's pretty good.
So that's a yield over the last 12 months.
Yield to maturity is 4%.
Like very little duration risk, if any duration.
Yeah, well, look at that. It's 96% banks.
Yeah, that's always going to be the case. There is one, I can't remember what it's called, that excludes the banks. I think it's the iShares one, potentially.
Right, I don't know off the top of my head.
Excludes the banks from the index, so you get a more diverse exposure.
That makes sense. Drew, we needed to get a dad joke from you.
Yeah, I'm going to ChatGPT again because I've had so much fun and it's been so good in the last few weeks. I've managed to get a laugh and my child will love this one.
I was thinking, and the community, everyone that's watching or listening can just maybe chime in on this. Just jump on the RAS community or leave comments on Spotify, on YouTube, wherever you like. I was thinking the loser of our $10,000 challenge, get this.
Live dad jokes?
Has to shave their head.
Oh, join us. I was like, oh, that's easy.
No, but let us know what the punishment should be for losing this challenge.
Like skin shave?
Yeah, well, whatever. But it could be anything. Let us know what the punishment should be. I think
cold water swim, but it's not cold anywhere.
Yeah, not at that time of year. Yeah. So let us know. We're down for it. We want to know.
Bourke Street Mall with something like free hugs or something like that. Yeah.
Bourke Street Mall, if you don't know Melbourne.
Bad ideas. Yeah, come on, Elon. Come on, Elon.
Let us know. I have strong conviction that my leveraged ETF will do something. I don't know what it will do, but it will do something before the end of the year.
Hopefully.
Yeah. Let us know.
NVIDIA doesn't struggle.
Drew, we need a dad joke from you. Drew, Director of Wattle Partners.
Why don't graveyards ever get overcrowded?
Don't know.
Because people are dying to get in.
I think I've heard that one before. Yeah. I don't know if you've
use it every time we go past the cemetery. We've said it so many times that my son now tells me that joke.
You've told us that one before. Yeah.
And then when you drive past, you'll say that's the dead center of town.
Very, very good. I feel like you're in your prime of dad mode right now. So
ChatGPT, thank you.
Well done,
Sam
Drew.
Altman.
Well done. And well done on your portfolio thus far, my friend. And enjoy it while it lasts.
Try grok next week.
So CSL, let's just recap a bit. CSL under a bit of pressure. Valuation is stretched. Growth outlook's not as compelling. Although analysts were still guiding for higher targets. XRF Scientific, very good results. Revenue top line a bit soft, but the profit is looking very good. We've seen some pretty interesting results out recently. Write in your questions and suggestions for companies that we will cover in the next few weeks. There's a lot of companies reporting the next 2 weeks. So, stay above water out there. Stay diversified. And we'll see you next week on the 2 Cent segment here on the Australian Investors Podcast. Drew, thanks for joining me.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.